Good day traders, Stanley Olo here for Simori Capital, and today we'll be learning about market size and liquidity. A quick recap of previous lessons reminds us of two things. The first thing is that trading has no physical location. The second thing we learned from previous lessons is that financial institutions play a bigger role in the FX market than retail traders. Because of these two facts, we're forced to ask ourselves, how do these institutions participate in the forex market? Do they also use brokers, or do they have their own means of participating in the FX market, right? The answer is they have their own means, and their means is known as the interbank market. Being that institutions are the ones that play a major role in the FX market, that means that the interbank network plays a major role in facilitating international trade. Alright? It allows a bank in Japan to be able to trade with a bank in the USA very seamlessly. Okay? This methodology of operation is known as OTC. And all OTC means is over the counter. Now, what OTC allows is for banks and non-banking financial institutions, or NBFIs, to interact with each other seamlessly, quickly, over a 24-hour period. Alright? That means that trade can be quickly and easily facilitated between one bank and an insurance company, between one bank and another bank, between a hedge fund and a mutual fund, and so on and so forth. The beauty about this is that all you need is an internet connection to be able to facilitate these trades, alright? So just like a retailer, provided you have a workable device and you have an internet connection, you have access to the FX market. But it's not the same at an institutional level, alright? For further knowledge and to help us understand upcoming concepts, we're going to list the most actively traded currencies on a global scale, rather in the FX market. And these are now, if you take note of these currencies, you'll realize that when you add up the percentages, it adds up to 200%. The reason behind this has everything to do with what we learned in the previous lesson about currency pairs, okay? When you look at these currencies, they're not standing alone. They'll always be pitted against another one. And that means that instead of getting 100%, you get double, okay? Because you have two currencies forming one price. Make sense? The next thing we're going to discuss is liquidity. When we talk about liquidity, all we're discussing is the level of activity in the market. Put simply, higher levels of activity mean higher liquidity. And the opposite is true. When you have lower levels of liquidity, it means that there's lower levels of activity. Alright? Now, liquidity is a function of two things. The first thing is the number of active traders, and the second one is the volume being traded. Okay? So when there's more traders in the market and there's higher volumes, that means that we have a high liquidity. When there's less traders in the market and lower volumes, that means we have low liquidity. As an example, we're going to use the euro against the dollar versus the Australian dollar against the dollar. Right? Now, if you look at these two, based off of the information that we just gave about the most actively traded pairs, what does it tell you? It tells you that in this example, the euro, being more traded than the Australian dollar, has a higher level of liquidity. While the Australian dollar still has a high level of liquidity because it's a major currency, but it has a lower level of liquidity than the euro. All this means is that there's more traders actively trading the euro against the dollar with higher volumes than those that are trading the Australian dollar against the dollar. Alright? Now, when it comes to liquidity in terms of currency pairs, if you remember from our previous lesson, we talked about the majors, the minors or crosses, and the exotics, right? When it comes to liquidity between these three, we'll find that the majors have the most liquidity, the minors have good liquidity but not as much as the majors, and the exotics have some of the lowest liquidity. Alright? Now, as a trader, let's say you don't really want to trade the majors because everyone is there, right? And you instead want to trade the minors. How do you choose what minor currency pairs to trade? Alright? Well, you can choose by the frequency that they are traded. And the three most traded currencies under the minor currency pair class are the euro, the yen, and the pound. Examples of this would be the pound against the yen and the euro against the Swiss franc. Alright? Provided you can understand these three and mix and match them not only with each other but with other currencies as well, then you should find solid opportunity within the minor currency pair class. Okay? Another thing we're going to discuss is the cost of trading. Alright? Now, between these three currency pair classes, the lowest cost of trading occurs right here under the majors. Alright? When it comes to the minors, it's not as cost effective as the majors, but it still isn't as expensive as trading exotics. So this means that there's a middle ground somewhere in the minors when it comes to cost. Alright? And when it comes to the exotics, this is where you'll find that you're paying the highest transaction costs. Finally, in terms of stability, you'll find that majors are the most stable. Now, when you look at major currencies and major currency pairs, you'll understand that they come from some of the world's most stable and strongest economies. That means that they're not very sensitive to political events, such as geopolitical events, and they're also not as sensitive to scandals. For example, if there's drama in a certain country, like the USA, it won't necessarily affect the performance of the economy. Okay. Just like before, it goes down in scale. So you'll find that minors are generally stable, okay, not so bad. And then you'll find that exotics are very unstable. So if there's a geopolitical event or a scandal, you find that exotics are most sensitive to such situations. The next thing we're going to discuss is dollar dominance, the US dollar in particular. When we talk about dollar dominance, we state certain facts. The first most obvious fact is that it's 1/2 of all major currency pairs. The second fact we know is that majors account for 75% of all trading volume within the forex markets. Now, if the dollar is part of 75% of all trading volume, what does that tell you? It means that the dollar is significant, okay? A simple way to put this is to say that the dollar is king. Another factor that contributes to dollar dominance is that 62% of global foreign exchange reserves are held in the USD. This means that central banks all around the world hold 62% of their assets as the US dollar, alright? Or under the US dollar as a currency. Meaning that if you approach a central bank and you look at its balance sheet, 62% of it on average will be the US dollar, alright? These are the major points. Number one, the US dollar is half of all majors, okay? Number two, majors account for 75% of trading volume within the FX markets. Number three, the dollar is king, alright? Which touches on our topic, dollar dominance, alright? And finally, 62% of global foreign exchange reserves are held under the dollar, alright? That means that any central bank around the world, their balance sheet consists of 62% USD, alright? Some other factors that contribute to dollar dominance are as follows. So these factors, as you can see, first off, the USA is the largest economy in the world, alright? The US dollar is the reserve currency of the world, as we saw here, by 62%. The USA has the largest, most liquid financial markets. So examples are the New York Stock Exchange, the Chicago Mercantile Exchange, the Dow Jones, the Nasdaq. All right, these are some of the largest, most liquid financial markets. You'll also see that the USA has a stable political system. It's a military superpower. The USA has the largest military force on the planet. All right, and it's half of all international loans. So if you want to take a loan from Japan, for example, and you're here in Kenya, you won't use the yen, you'll use the dollar, surprisingly, all right? So that means converting your Kenyan shillings to dollars, and then your dollars to the yen, and then you can find the cross conversion, and then find the equivalent Japanese yen to Kenyan shilling transaction, all right? Next is also the most used cross-border transaction medium. All right, and a prime example of this is the fact that crude oil, is priced in US dollars. All right, and it's known as the petrodollar. And then finally, all this means is that the global economy is highly dependent on the US dollar. All right, to function. So whether it's international loans, whether it's ensuring that countries can afford to bring in fuel and food and so on, you'll find that they're mostly transacting in US dollars. All right. The final thing we're going to discuss is speculation. Now, speculation is the art and science of predicting the future, to put it simply, all right? It's based on the present and uses certain pieces of information in order to achieve a desired outcome, all right? Now, before we dive further into that, we'll look at the main functions of the Forex market. The first function of the Forex market is in its name, its definition, foreign exchange. And all this means is transfer currency from one country to another, all right? The second function of the FX market is to provide short-term credit to finance trade between countries. The third thing is to hedge against fluctuations in the FX market, all right? And the final, most important reason why we're here, which is to make money, is speculation. So to summarize, first, the function of the FX market is to transfer currency from one country to another, all right? As we know, different countries have different currencies, and you can't use your own home currency in another currency. You need to convert it, all right? So that's what we know as foreign exchange. The second thing is to provide short-term credit to facilitate trade between countries. What this means is that if I want to transact maybe in the UK, I will use the Forex market in order to gain short-term credit and do my business there, all right? The third thing is to hedge against fluctuations. As you know, the Forex market isn't stagnant, all right? It goes up and down. And what that means is that if you translate your home currency into another country's currency, you might find that it's either appreciating value or depreciating in value, all right? So to maintain the value at which you've traded it at, what you do is hedge. And we'll get into detail about it later on in the course, all right? The last thing, and this is why we're here, is speculation. So speculation allows you to predict future moves based on what you're currently seeing, all right, in the present. Okay, so now let's dive into speculation. The first fact about speculation is that most trading occurs on the basis of speculation. So what does this tell us about speculation and how to define it? It means that traders buy and sell based off of short-term market fluctuations. Another fact about speculation is that it accounts for 90% of trading volume. And this buying and selling volume is what creates market liquidity. Now, when we talk about market liquidity, it's the ability to buy and sell major volume without causing major price impacts, okay? So someone can buy $10 million worth of a particular asset and it won't even affect the price per se, understood? So that means that the Forex market is highly liquid, okay? Liquidity is very important for short-term traders. Why? High liquidity allows major changes in price, all right? So when there's high liquidity, you might see a 1% move, and that's a lot in the forex market. You might see a 1% change in a certain price. But when there's low liquidity, you might only see a maybe 0.2% change, okay? So for short-term traders, this is important because it allows them to make substantial gains off of these short-term moves, okay? The last thing we need to acknowledge is, despite the presence of liquidity, we also have something known as market depth, all right? And depth is what determines price movement, all right? So depth is based on the currency pair that you're trading, as well as the time of day, all right? A very liquid pair like the euro against the dollar will only move significantly at certain times of the day, all right? All right? And this means that its market depth is determined by various session opens and closes, and we'll get into that later on, all right? So this is all we need to know. When it comes to speculation, first off, most trading occurs on the basis of speculation, all right? So that means that everyone who's participating in the forex market, most especially institutions, are looking at it from a future point of view, anticipating what will happen, all right? Based on what has already happened and what happened way in the past, okay? Buying and selling based on short-term price moves is the definition of speculation, all right? So when I'm saying I'm speculating, I'm either buying or selling based on the short-term price movements, all right? So there's certain indicators or price patterns that will allow me to take advantage of a particular currency pair. 90% of trading volume is done through speculation. This is big. That means that the forex market is just this huge place where most people are simply trying to anticipate what will happen, all right? Speculation is what invites liquidity. And liquidity, as we know, is buying and selling, all right? Liquidity is activity plus volume, all right? So when you have high activity and high volume, you have high liquidity. Low activity and low volume, low liquidity, okay? When we talk about market liquidity, we say that it's the ability to trade a large volume without causing significant impact on price, okay? And then finally, we said that FX is very liquid. That means that in the FX market, a trader, an institution, can buy $1 million, $10 million worth of a particular asset class, and it won't adversely affect the price, okay? On this end, we said liquidity is important because it allows speculators to take advantage of short-term price movements, all right? So if you're a short-term trader, for example, a day trader, someone who will wake up, identify certain chart patterns, open a position, and hope to close at the end of the day, you depend on liquidity, all right? It's your bread and butter, okay? Finally, we said that despite liquidity, another thing that we need to take note of is market depth, meaning that market can be affected by, first off, the asset class that you're trading, and secondly, the time of day that it's being traded, okay? So that's all the time we have for today. Join us next time as we learn about how to trade FX, okay? I've been Stanley Owilo here for Simori Capital. I'll see you in the next one.